Hi, welcome to Chapter 11, Part 2, all about corporations, how they're organized, the stock transactions, dividends, and retained earnings. In Part 2, we're going to look at issuing common stock, accounting for treasury stock, and some differences between preferred and common. Welcome back. Treasury stock, that is new this chapter. That's another new account to learn. So here we are with our little review: paid-in capital, common stock, and preferred stock, earned capital, retained earnings, and we now have a new line item here, treasury stock. And treasury stock is going to be deducted. What is treasury stock? Treasury stock is the company's own stock that it has reacquired from shareholders but has not retired. So the company's gone out to the stock market and purchased back its own stock at market price. What is the company thinking? Why would they do this? There's 5 big reasons. 1, the company needs shares of stock to pay officers and employees under some sort of stock compensation plan or bonus plan. So maybe they pay their executives bonuses, but they pay them in stock. They need stock to pay them. Why don't they issue more shares? They choose not to do this. They want to keep the outstanding shares, they want to keep the issued shares the same balance. By pulling stock in from the stock market, this could stimulate the market and create some demand. Another reason the company would want to have shares of stock is if they're acquiring another company. For example, when Pepsi-Cola bought Quaker Oats, the Quaker Oats stock was retired and exchanged for Pepsi stock. So Pepsi had to have enough stock to compensate all the Quaker Oats shareholders. Now, if you have less stock outstanding and actively traded in the market, the calculation for earnings per share changes. Earnings per share is calculated by net income divided by outstanding shares of common stock. If you have less shares outstanding, it will increase earnings per share. And it could have the effect of getting rid of disgruntled investors, or maybe investors who are trying to plot for a takeover. You just buy them off. Okay, what's the journal entry for treasury stock? Treasury stock, as I showed you earlier, is deducted from stockholders' equity. The stockholders' equity accounts, common stock, retained earnings, preferred stock, all have normal credit balances. You will debit treasury stock for the price paid to acquire those shares. So the normal balance for treasury stock is debit. Treasury stock is a contra stockholders' equity account. It is not an asset. It's got a debit balance, but it's not an asset. It's a contra stockholders' equity account. We will debit treasury stock at cost. We are using the cost method. There are other methods to record treasury stock, but not usually discussed until intermediate or advanced courses. So let's look at a balance sheet. Here's a company, and I'm making this balance sheet very simple. I'm saying this is Geo Company, or Geo Inc. Paid-in capital consists of common stock, $4 par value, 100,000 shares issued and outstanding. Total balance $400,000. I'm not showing that this company has any additional paid-in capital, just to keep this illustration simple. Retained earnings $200,000, total stockholders equity $600,000. Okay, February 1st, Geo acquires 4,000 shares of its stock at $7 a share. So we account for this at cost. We debit treasury stock $28,000, and of course we credit cash $28,000. And please remember, for test situations, please always do a description on your journal entries. Okay, so this is a debit to treasury stock. So how does this look on the balance sheet? Now, the change is here. $4 par value, $100,000 shares issued, and 96,000 shares outstanding. In the last slide, we said issued and outstanding. Now we've got to be more specific. in our description. Retained earnings doesn't change, and we subtract treasury stock, $28,000, for a total stockholders' equity now of $572,000. By buying that treasury stock, we reduced cash, the left side of the accounting equation, and we reduced stockholders' equity. And you can see the number of treasury shares is also disclosed. Okay, let's finish up with a discussion on what are these terms: authorized, issued, outstanding, treasury stock. Let's assume 1,000,000 shares are authorized, 400,000 shares are issued, and 15,000 shares are in treasury stock. How many shares of common stock are outstanding? Well, the treasury stock reduces the number issued. So in other words, outstanding plus treasury stock equals the number of shares issued. So just because it's treasury stock, it also means it has been issued. And you'll notice this pink area is all stock that is what? Unissued. Unissued shares have no value. Again, they're just the maximum number of shares that the company can issue. And by the way, when you issue additional shares out of the company's unissued shares, that has to be approved by the board of directors and voted on. So the unissued shares add up to 600,000, and the active shares, 385,000 outstanding, 15,000 in treasury. They are both considered issued shares. Okay, let's get rid of treasury stock. The company buys treasury stock, and let's say they turn around and resell it. Of course, it would be a minor miracle if they resold it for exactly the same price that they purchased it. So they're going to resell it for above cost or below cost. Both will increase assets, because when you make a sale, you're going to increase cash, and they'll increase stockholders' equity because you're getting rid of treasury stock. So let's take an example. On February 1st, as a review, Geo Company acquired 4,000 shares of its stock at $7 a share. Okay, later on, Geo sells 1,000 shares of this for $10 a share. Now you can see that they've made an increase of $3 a share here. So the first thing we do is recognize the cash coming in, debit cash for $10,000, and we reduce the treasury stock at the value that we purchased it at, and the balance goes into a new account, paid in capital treasury stock. This means we sold the treasury stock for more than we purchased it. We do not recognize a gain or a loss from stock transactions with its own stockholders. So this is treated almost like a first-time sell of stock. Okay, let's take a loss. I shouldn't say loss. Let's say we sold the treasury below cost. Now we've already done the first sale, and I want you to keep track of that. The first sale was for 1,000 shares. This sale's for 800 shares. And we have now, the market has dropped and we're selling it for $6 a share. Debit cash, 800 times 6. Let's get all these entries up. Whoops, sorry. Credit treasury stock at the cost we purchased it at. And we have an $800 debit that we have to make. Now we're going to go into that paid in capital treasury stock that we credited in the last journal entry. And we are going to use as much of that up as we can. And we still have a balance in paid in capital treasury stock. Okay, let's say that we're going to sell off the last 2,200 shares, also at $6 a share. Cash will be $6 times 2,200. Let's get these here. Treasury stock credited, 2,200 shares times $7. We're going to use up that remaining balance in paid in capital treasury stock. We started out with 2,000. We reduced it by 800 in the last journal entry, and this is the the remaining 1,200, but we still need 1,000 to balance this entry. So we're going to debit retained earnings. Okay, please take a shot at doing problem 11-2B, and again the solutions are in the back of part 3. Welcome back. We're going to do a very brief discussion of preferred stock. Preferred stock, it gets preference as to dividends. They get preference as to assets in liquidation, and they're non-voting. Assume that Moreland Company issues 9,000 shares of $10 par value preferred stock for $12 cash per share. What is the journal entry for an issuance of preferred stock? Debit cash, credit preferred stock again at par value, and credit paid-in capital in excess of par preferred stock. So pretty much identical to the issuing common stock, just a slight account title change. And we're going to talk more about preferred stock in the next part, but I wanted to just launch that discussion here. Thank you.